Joining us now is Wells Fargo Senior Global Equity Strategist Wren. Scott, good to see you this morning. Assess the situation for us. We're looking at markets that are off of the lows this morning, but nonetheless expecting a triple-digit decline right out of the gate today.
Yeah, Maria, we're going to test this 200-day moving average, I think, pretty heavily here on the open, that's should be something that people pay attention to. But, for me, what I'm trying to do and for our clients is break this down into just some basic components. And the first component that we want to do is, we want to put this in the right perspective. If you look at from the beginning of April until the high that was on September 20th, I mean, the market ran almost 14%. We barely had a pullback at the end of June. So when the market runs that hard, that far, in that short of a time, I mean, you're going to cough up some of those gains at some point, and I think that's partially what we're doing now, and it's because of concerns that we've been talking to our clients about for at least the last year and a half. In 2018, in our opinion, the two biggest risks have been, is the Fed going to make a mistake? And then is global growth going to slow down? So, I mean, I think those are exactly the concerns. Those basic concerns. We're later in the cycle. People are worried about higher interest rates, inflation, all those kinds of things. So, really normally I would consider, a 5% pullback. I mean, that's noise. That can happen just about on anything. And I think it's a buying opportunity down here.
But, Scott, look at interest rate sensitive sectors this year. Stephanie Pomboy emailing about this. So the automakers have been down, a double-digit decline there. Home builders down. And then yesterday we had the transports, again, economically sensitive, wiping out all their gains so far this year. Are those the canaries in the coal mine here?
Dagan, I don't really think they are. I mean, I think that interest rates, you've got the 10-year up at 3.18 this morning, or right around there. In my opinion, that's just reflective of we have better economic growth, we have slightly higher inflation. I mean, 3.15, 3.20. I mean, that is not panic level on the 10-year Treasury. I guarantee if you look in history and you say, gee, are we going to have 3% GDP growth should the Treasury, 10-year Treasury be trading below 3.20? I don't think you'd see that correlation if you look back in history. So, rates are still low. I don't think in any way, shape, or form this pop over 3% is the reason behind this. It's fear of what's going to potentially happen. And Dagan, you brought up a point when I was sitting here listening. The market, we know there was going to be great earnings growth this year. I mean, we had the big tax thing, but next year, I mean, the market's been thinking about 2019 earnings, which are not going to be anywhere near 2018 earnings. I mean, I think they'll probably be 7 or 8% next year, which is fine.
Right.
But the market's thinking ahead on that, and it's just worried about the Fed, worried about global growth. All that late in the cycle makes sense to me.
Right. But, I mean, there has been this narrative out there for some time that things are going to slow down in 19 going into 20. So why now? And I was under the impression that you really want to see a serious sell-off in order to get back in. You're seeing this as a buying opportunity. Does it bother you that people are coming back so quickly because this market is already off of the lows?
Yeah, it is off the overnight lows. But, Maria, our year-end target has been 2,800 to 2,900 in the S&P 500 for year-end. So, in our opinion, at least for this point in time, the market's pretty close to fair value. But when we look out 12 months or something like that, I think you could see a 8-9% return in the S&P 500. So, we want our clients in this. They're not buying stocks cheap right here. But retail clients in general, not just our clients, but I would say our competitors as well. They've been sitting on a lot of cash. They've been underinvested in stocks this whole run. You get down, you're down 5%, which isn't much. We see a little bit more. I mean, I think it's time to put your toe in the water if you believe that the Fed is not going to make a mistake, if you believe that global growth is not going to slow, which that's our base case. So, we want our clients forward-looking. We're positive. We want our clients in here, and you probably won't see much gain through the end of this year. But when you look out over the next 12 months, I think you'll see some positives.
Scott, Lindsay Bell here. Just a question on tech. Yesterday it was it took such a nosedive. The S&P 500, I think 80% of the tech sector names were down for the day. Amazon really caught my eye because that was the one holdout in this sell-off that we saw earlier this year. It was down 6%. What are you thinking of when you look at tech going forward? Are you telling your clients maybe this is a good buying opportunity for some of those names?
Well, you know, and Lindsay, you know, with the reconfiguration, the GICS reconfiguration, we're neutral on technology. We had been before the change. We initiated the communication services sector with an unfavorable rating. So, you know, the FANG stocks obviously, you know, 3 or so have moved into this new sector. So I think that there's some concerns about growth there. I think there's concerns about regulation. I think we're going to hear more and more of Washington trying to stick their nose in these technology companies' business. And clearly, a lot of those companies have been really driving what's going on. But saying that, if you look at the stats, I mean, tech is still up. The sector tech, the current sector tech, it's still up over 10% on a year-to-date basis. So, you know, I don't think you can complain too much about that. And I think you want to be at that 20% weighting that technology now represents in the S&P 500.
I was just going to say either that resiliency in technology stocks, it bodes well for them, or it's a sell signal because it's like, wait, they still have room to fall. I'll just leave it at that. I'm laughing.
Yeah.
I know
you're going to need more than just tech to bring the S&P up. You're going to need capital goods. You're going to need transportation. You're going to need a lot of the industrials to actually get on board if you're going to see a bottoming out. What did you want to say?
Yes, Scott, just for you mentioned the concerns about global growth. How should long-term investors want this China stare down the president is having resolved?
Well, we would argue that there is a relatively low probability of an all-out trade war, which I mean, it's hard for me to say we're having a trade war right now. I look at a trade war as 50-60% tariffs across all goods coming from a country, and we're nowhere near that. I think clearly we saw with the newly negotiated deal with Canada and Mexico, that was a positive. We have a new deal with South Korea. I think over time, and this is not easy, but, you know, we're going to see some positive outcomes with the EU. And I think eventually we'll probably all get together and have some positive outcomes with China. But now that's going to take time. That's harder deals to negotiate. But I think that, you know, our analysis is we're not going to have an all-out trade war with China.
All right, we'll be watching. Pretty positive there, Scott. We'll be watching the developments. Thanks for weighing in this morning. Good to see you, sir.
Have a good day, guys.